Hi, welcome to the First Trust ROI Podcast. I'm Ryan Isakainen, ETF strategist at First Trust. Today I'm joined by Brian Wesbury, chief economist at First Trust. Brian and I will talk about the U.S. economy, the likelihood of a recession, why inflation surged and then has come down, and the likelihood that it will reaccelerate, as well as the Fed policy, where we go from here, a number of other topics. It should be a great conversation. I hope you enjoy. Joining me today is Brian Wesbury, chief economist here at First Trust. Brian, thanks for joining us on the podcast.
Ryan, great to be with you, as always.
So you've worked in Washington. You've worked in the private sector.
Don't hold it against me.
You were chief economist for the Joint Economic Committee for the U.S. Congress. Have I got that right?
You did.
Okay, so my first question for you is, what is it like working in government versus the private sector? Is government everything we imagine it to be?
First of all, I'm glad I'm gone. But actually, I will tell a little story. I used to do business radio in Chicago. They have a lunchtime business hour on one of the big AM stations there, and Len Walter was the host. And when I came back from Washington, I started doing his show again. Finally he stopped me one day. He goes, "Brian, before you went to Washington, you spoke in sentences. Now you speak in paragraphs. This is a problem." And I made a lot of great friends in Washington, D.C., at the Wall Street Journal, in politics, on Wall Street, in a lot of different areas overseas, because we got to visit with a lot of overseas other economists and Treasury officials. So those relationships have stuck with me. Some of the developments from those relationships have obviously stuck with me. I'm a member of a few different groups that I wouldn't be today. However, I will tell you, I would recommend to anyone that they take Milton Friedman's advice, and that is never go to Washington, D.C. to work. It is especially now with government so big, you begin to think you are the center of the universe.
Right.
And I think that's a dangerous thing.
Okay, so one of the things that you do for First Trust is you give a lot of speeches, a lot of talks around the country. You talk to a lot of investors, a lot of investment professionals. What do you think most people don't quite have right?
Yeah, that's a great question. I guess let me put it this way. A lot of the things that I believe to be true about the economy come from Adam Smith, who wrote in 1776.
Okay.
Economists that other people have never heard of, Ludwig von Mises, Friedrich Hayek. They were both Austrians. Everyone's heard of Milton Friedman, but he was a hero and still is a hero of mine. But those economists, if you will, if you put them in a pool, and there are many, many others, I left that list short, are opposed to sort of the Keynesian kind of view of the world. So it's really all about how the world works. Does it work from the demand side? In other words, we have to have people buy stuff to make the economy grow, or does it work from the supply side, which is inventions and entrepreneurship are what make the economy grow? I am a supply sider. It turns out that puts me in the minority of economists, especially academic economists out there, and that's what I think a lot of people who learn Keynesian economics in school, in academics, are missing a lot of where wealth actually comes from, and how we produce growth, why it falters, where recessions come from, and that's what I think Milton Friedman, the Austrians, and Adam Smith gave us a much better view of than John Maynard Keynes.
So is it fair to say that in most circles in government today, especially in Washington, it would lean more towards the Keynesian school of thought.
Absolutely.
Yeah.
I mean, if you think about John Maynard Keynes is the one that invented really in the Great Depression. He said when unemployment goes up, people can't spend because they're not making incomes, right? If you've lost your job, so it's then time for government to spend. And then a lot of Keynesian economists that have followed along have created new kind of models within this Keynesian framework. One of them is that if we increase unemployment benefits by $1, it has a multiplying effect on the economy. It actually increases economic growth by $1.30, and that when we're in a recession, we ought to run a deficit. And so if you're a politician, this is great news because it's a free license to spend.
Yeah.
And by the way, they always spend other people's money. So they love John Maynard Keynes because these deficits and now we have permanent deficits are just part of the economic model. I think we're abusing all of this today, by the way. If unemployment was 3.5%, which it is today, John Maynard Keynes would argue vehemently against increasing the budget deficit because that's full employment. I don't think we ever need that deficit spending, but put that aside. Keynes would say we need it if unemployment's high. We don't need it if unemployment's 3.5%. And yet here we are doubling the government budget deficit in the last year. And that's what we wrote the other day is this is the least responsible budget we've seen this year ever, maybe in the history of the United States, because the unemployment rate is so low. And we also argue that John Maynard Keynes is probably spinning in his grave.
So there's still hundreds of billions of dollars of these fiscal programs that were set up, especially during COVID, all the different acts, the Inflation Reduction Act, the Infrastructure Act, the CHIPS Act.
Right.
And those are set to be spent over the next, 3 or 4 years even still. So I'm guessing you would argue that that's not a good allocation of resources. Is that?
Yeah, I totally agree. I mean, I'm not saying that we shouldn't build computer chips. I think the private sector ought to do it.
Right.
In fact, the reason we passed the CHIPS Act is to compete against China, which means we are competing against China in the same way China does business.
Right.
And America is a capitalist country, or supposed to be. China is a communist country. You don't want to emulate you can't emulate the communist. They're better at being communist than we are. Right. Let's put it that way. So I think it's a waste. Second thing is there is the way. I do not believe government spending actually increases growth. And I would add in the long term, like the medium term too. In the short term, like we saw during COVID, if you pay people not to work, it can increase spending when it shouldn't have increased. So I'm not arguing that it can't boost growth in the short term. But this year we had so much of that spending happen. Next year, when you look at deficits, they always have to keep getting bigger to have a positive impact on the economy. If they ever you can have a deficit, but if it's smaller than the year before, then it's a negative impact on growth. So I think 2023 is the peak. It's also the peak of all the money we printed as well. So this is the last year where we're going to see those types of spending bills really have any kind of measurable impact on economic growth. And then what we're left with is all that money printing created inflation, all this bigger government misallocated resources. Because think about it, if we build $200 billion worth of semiconductor plants, that's 200 and government subsidized that.
Right.
It sucked $200 billion away from other kind of manufacturing or investment that maybe we should have done. And that's what happens with government spending. It distorts investment over time, and I think that slows growth in the long term. That's why I don't think government spending is positive in the long term. In fact, it's negative because it pushes resources to places that are less efficient.
So, and it definitely has an impact on you were talking about the deficit. Now, I'm curious how it will play out, and it's in the future, so none of us knows. But do you think that Washington is going to develop discipline at some point, and these deficits will come down? Will they be forced to?
Yeah, you would think that what is unsustainable will end, right? But I will tell you, I thought it was unsustainable during COVID, and here last year the budget deficit on a cash flow basis, and we won't go into the accounting of the student loans and all that stuff, was $1 trillion. This year it's $2 trillion on a cash flow basis. That's astounding to me, especially when we have $33 trillion in debt. We know Social Security, Medicare, Medicaid are going to hit the wall within the next 10, 15, 20 years. And it's almost like they're willfully blind. And that's sort of par for the course for politicians, because they only have to worry about the next election. They don't have to worry about one 10 years from now. And so they never address a problem until it becomes so front burner, so it hits the windshield. That's when they address problems. So it's amazing. I mean, people have all kinds of conspiracy theories about what government is trying to do, but it's pretty clear that Build Back Better, or reimagining the economy, or the Great Reset, these are not conspiracy theories. The politicians all over the world are saying them, especially in the West. Boris Johnson, Trudeau in Canada, all these politicians said these things during COVID, and they really do want to remake the economy. They want to push all these resources towards solar and wind. And for the record, I'm for clean air, right? However, I'm also for sustainable growth. And so far, solar and wind cannot replace fossil fuels, and they won't. By the way, we're going to use more fossil fuels, oil and natural gas, in 50 years, no matter how much they try, because you need to produce all the energy to charge the batteries and make the cars and all of those things. And so the point is, they're trying to push the world in a way that it doesn't want to go. And that would be, to me, the real problem here. It's not just the deficit, it's that we're pushing resources in directions that aren't as productive as the ones that the free market would find.
So it's more of a kind of a command style economy that they're advocating for. So I want to talk a little bit about inflation. You were one of the early forecasters that said inflation's coming, and it had a lot to do with your views on, you were talking before about your supply side views and watching M2. So where we are right now, it looks like inflation has begun to come down. Some people think we're out of the woods. What do you think?
Yeah, this is so Milton Friedman, I knew him when he was alive, and his wife, Rose. I feel really lucky about that. He taught me to watch M2, and that's why we were, I'm not trying to pat ourselves on the back, but I don't know many people that beat us to the inflation forecast back in July of 2020 was when we really started writing about it. And it was pretty simple to me. They printed so much money, monetized the debt in order to pay PPP loans and pandemic unemployment benefits, all of those things. It was pretty easy. When you print that much money, the value of the dollar goes down. And I'm not talking about the euro and the yen and the pound, because they all printed more money too. What I'm talking about is versus a gallon of gas or a loaf of bread or a house. And so that was easy to see. Well, now the money supply has turned around, and what Milton Friedman said was there are long and variable lags, especially with inflation. So when you tighten the money supply like we have done. They finally stopped printing more. In fact, in the past year, the money supply is down 4% from the year before, which is the first time since the Great Depression. So I would expect that to hit growth, and this is what Friedman said, in 6 to 9 months, and then inflation in 18 to 24. Now, having said all of this, the supply chain issues that we had and Putin invading Ukraine, those don't cause inflation, but they can put pressure up on prices in a way that can make this. The CPI is not a perfect measure of inflation. It's just kind of the best we can do, and so it can put upward pressure on the CPI. I think it probably pushed inflation higher than it really was, but we're down to 4.5% now. I think we're going to stay around there for at least the next 12 months. If we get a recession and the Fed reverses course, cuts rates, starts doing QE again, because remember, a recession means unemployment will be going up in an election year. And so that's and this is the scary part to me, because that's exactly what happened in the 70s. The Federal Reserve would go, oh no, we created inflation. They would tighten the money supply, they would raise interest rates, and then that would raise unemployment. Even though inflation turned over a little bit, then they would get scared and they would lower rates and start printing money again. Inflation would never go back to that full 2%, and then it ratcheted back up. And every time they did it, it kept ratcheting higher. So when Jerome Powell says we're gonna be as tight as we need to be, what he's saying is we'll avoid this 1970s. The jury is still out. Is he going to fold like a cheap lawn chair, or is he really going to keep his foot on the brake until inflation goes away?
So the fact that we're heading into an election year, do you think that will have an impact on the way that Fed conducts policy next year?
Yes, definitely. Yeah. I do believe they'll raise rates at least one more time this year. Mm-hmm. By the way, just today, but we see this all the time, we got housing prices for July of 2023, and both of them were up 7, 8, 9 tenths, both the big measures. FHFA and Case-Shiller, but it doesn't matter. These are the two measures, and this is kind of a shock because it seemed like housing prices were slowing down, mm-hmm. and now all of a sudden we get a month where they jump. And this is what I mean by inflation's not gone yet. It takes longer than just 10, 12 months of tighter money to fix inflation. It takes 18, 24 months. And that's why I worry about the election year, because for them to truly get inflation back to 2%, they're going to have to stay as tight as they are today well into next year, maybe all year. But if we get a recession and unemployment goes up, they'll reverse course, and that's when they blow it.
One of the things that I've heard you talk about over the last several months that I haven't heard from many other places is the way that the Fed is using an abundant reserve policy versus a scarce reserve policy. And for those that maybe aren't familiar with that change, can you talk a bit about what that means?
Sure. And I'm going to just warn people a little bit. I think I've found a way to talk about this that makes it and I don't mean to discount how smart anybody is, but very few people focus on the Fed as much as we do. And so if you go back to Ben Bernanke in 2008, he changed our monetary policy. So prior to that, we used a scarce reserve model. In other words, the entire banking system needed about to meet reserve requirements. They had to have 10% reserves in their banks, and every quarter they had to make sure that they met the requirement. And some banks at the end of the quarter would have like 9%, and other banks would have 11. So the one with 9 would call up the one with the 11, and they would trade. They'd get their 1, and now everybody has 10, and the Fed's happy because everybody's following the rules. And so that meant that banks had to have federal funds trading desks. Okay, so every bank in the country did, because they all had to true up their reserves, and everybody was always a little low or a little high, and there were just enough reserves, what we call scarce reserves, to have this kind of work out. Well, then,
so that's a market-based rate, is what you're saying.
Now the Fed had influence on it, so we don't want to, forget that if the Fed added a bunch of reserves, they could drive the federal funds rate down. If they took a bunch out, they could drive it up.
Right.
But the banks actually traded, bids, asks, trading every day. Every day they traded. Mm-hmm. Well, guess what? Banks today, because of quantitative easing, we flooded the banking system with excess reserves, and banks don't have federal fund trading desks anymore. They don't need to trade them because every bank has excess reserves. And so at the end of the quarter, they don't, they're actually, most banks are sitting about 30% reserves, when back before 2008, it was like 10. Mm-hmm. So this is how big the Federal Reserve has become. But it's got, I know financial advisors who they lost their job on the federal funds desk, and now they're financial advisors because they had to go find somewhere else. They knew a lot about finance. They're great financial advisors, but those jobs are gone. So then the question becomes, all right, if banks aren't bidding and asking and setting a market for where the federal funds rate goes, mm-hmm. where does it come from?
Right.
And my answer is pretty simple. The Fed just makes it up. I mean, if you think about it, an interest rate should be inflation plus 1%. If you're the Treasury, plus 1.5% if you're Apple. If it's your cousin Vinny's best friend starting a bar, it's inflation plus 94, all right? But inflation is the core. The reason fixed income, or the reason I would invest, or anybody should invest in fixed income, is to protect themselves from inflation over time. Well, if you look at what the Fed has done in the past 15 years, during this abundant reserve model shift, they've held interest rates below inflation 85% of the time over 15 years. They held them at 0 for 9 years. And no wonder Silicon Valley Bank had trouble, because they thought rates were going to be 0 forever, and that they could buy a 2% mortgage or 2.5% mortgage, 3% mortgage, and make money. Well, now all of a sudden they have to pay depositors 4.5%, 5%, 5.25%, and those loans only pay them 2%. And this is why banks are in trouble today, because the Fed artificially held interest rates so low for so long that people got used to this, thought this was the new world, but you can't do that. It's like gravity is real. I mean, you can hold a 5-pound weight up above the ground. I mean, you're stronger than me, so probably longer than me. But eventually that thing's going to hit the ground because gravity doesn't go away. You can't hold interest rates at 0 forever and expect that to last. And now that's what we're finding out.
So in the past, there's been certain reference points like the Taylor Rule, and there's different versions of the Taylor Rule. Right. Last I looked at, that's something around 6%, maybe 6.5%.
Right.
I guess given that they're maybe making things up, what's the appropriate policy rate? Is there any way to know that?
Yeah.
Where should they be?
Yeah. So it's interesting you bring the Taylor Rule up, because one of the key parts of his rule, like where should the federal funds rate be, is he would look at inflation, relative to where the target rate, and he'd also look at growth, and that would be the real rate. So you have inflation plus 1%, or I use a simple rule. I just use called nominal GDP. It's real growth plus inflation. So that gets me. That's what I mean when I say inflation plus 1 or inflation plus 1.5. And so the Taylor rule is just a version of that. It's like, we know inflation is an important part of an interest rate. If the economy is growing faster, rates probably ought to be a little higher. If the economy is growing slower, they ought to be a little lower. But inflation is key. And so his rule has, I think it's worked really well. I use a simpler rule. I just use
the Wesbury rule of thumb.
I just nominal GDP. Yeah, that's all it mattered.
Yeah.
And I would argue, well, at zero, when Jerome Powell was holding rates at zero, they were way below the Taylor rule, way below the Wesbury rule, if that's really what we want to call it. But today they're about where they're supposed to be. And so we have money supply slowing down, rates, they're not tight yet. So if you go back to Paul Volcker, he was way above the Taylor rule. And then that caused, actually, I think it caused some deflation. I think he was too tight. But today they're just about right. I think they're going to go a little higher. If inflation falls, then they're too high. But for the first time in 15 years, interest rates are about where the Taylor rule says they should be, which is actually good news because they're no longer artificially stimulating the economy. And I don't know whether, I'm sorry if I'm jumping the gun on the question I've asked myself is, why did they hold rates so low for so long?
Yeah, that's a great question.
And
pretend I asked that question.
Yeah, all right. and one of my answers goes back to what I was talking about, where the government wants to push resources toward solar and wind and like reimagining things. And if you're the government, you have $33 trillion in debt, right? Do you want to finance it at low interest rates or high interest rates? And if the Fed can hold them low artificially and get away with it, you want them to do that. So that's part of it. The other thing is these solar and wind projects, more of them will make sense at 1% rates than do at 5% rates.
Oh, yeah.
And if you look closely at the news, I mean, I think if you go Google, canceled wind projects, you'll find 4 or 5 projects that have been canceled now. 2 reasons for it. One, the cost of a windmill has gone through the roof because of inflation. But number 2, the financing cost has gone up. And so, the projects that were built during that low interest rate environment are now unprofitable because they're paying more for their interest, the debt that they used to build these projects, and now they want to raise electricity prices. So I think what Ludwig von Mises and I you may want to go read his books if you have trouble sleeping, read his books. But he said when you hold interest rates too low, you get malinvestment, bad investment, and I think we have seen that. And I think we're not done with banking problems. We're not done with some of these big government projects funded with government debt problems. I think we're not done with the inflation yet because we were so low for so long. And if they cut rates again and do QE again next year, it's just going to get worse.
So it's interesting. You bring up the period of ultra low rates where we had ultra low inflation. And again, I've heard you talk about this before, the fact that, the Fed policy rate doesn't necessarily have the impact on inflation that we think it does. It's so talk a bit about that. Why did we go through that period of time where we had ultra low rates and yet we still had low inflation?
Yeah, it's in my view, it's not the rates. So it's not the rates that are determinant of inflation or not. It's the money supply growth. So Ben Bernanke held the federal funds rate at 0 for 7 years. And yeah, we didn't have inflation. We had 1.5% inflation. Jerome Powell only held rates at 0 for 2 years, and we got 8% inflation.
Right.
All right. So what the heck? Like, is it really about 0 rates? No. So what Ben Bernanke did is he did all the quantitative easing. He flooded the banks with abundant reserves, then held interest rates at 0. But at the same time, he pounded banks with new capital requirements, new liquidity rules, so that all that money it just filled the banks up. It's like making foie gras. You like stuff the duck with corn and the livers grow, but you don't let it out.
Yeah,
that's a terrible thing to think about. But anyway, but that's what happened. So the money supply didn't really grow in that.
So it just sat on the balance sheet of the banks.
It just sat there because they made them hold more liquidity, made them hold more capital. And so that was QE 1, 2, and 3 is what we always referred to it. I say pandemic QE was 4, 5, 6 because it was the same $4 trillion and we just did it again. But this time we paid the banks to make loans. PPP loans and we also direct deposited unemployment benefits. So the Fed printed money, bought treasury bonds. The Treasury then gave it out in unemployment benefits as direct deposit into banks. And so what happened is this time the money supply exploded and we printed 40% more dollars. A simple example of this is if the pineapple crop, if we increased it by 40% and the demand for pineapples didn't change, the price of pineapples would plummet. And if pineapples were friction-free, they never went bad and didn't cost anything to ship them or whatever, the price would fall by 40%. Money's pretty frictionless. It's way less friction than pineapples. And so you print 40% more money, you're going to get 40% higher prices than would have existed if that hadn't happened. So I believe it's not about the rates that cause the inflation, it's the money supply. And they both kind of work together, but when we switch from a scarce reserve model to an abundant reserve model, we separated. Each can now move. They used to move way more correlated. Now they move wherever the Fed wants them to. And that's the biggest problem. We are now, I ask people all the time, how many people trust the CDC and the NIH? And a lot of people after COVID don't. Some people trust them more, I guess. But a lot of people I know don't. What I tell them is they're bureaucrats, so is the Fed. And if you think the CDC made mistakes during COVID, imagine the kind of mistakes the Fed can make. And by the way, money and the value of our money is as important as our Constitution, because what we work for, what we save for, it's all stored in money. And if the value of money changes, it distorts every decision you make. And that's what scares me about this, is that they literally have gotten themselves, the Fed has gotten themselves into a position where they control the level of interest rates direct. They just make it up. Well, think about this. Every time we debate about the Fed, we go, are they going to raise 25, 50, 75? Are you going to do it in November, in September, in July? Like, what market do you know moves in 25 basis point increments? Price of corn, oil?
I don't think so.
Apple stock? Like, no. I want to go to a Fed meeting and go, how about 31.5? And they're going to go, oh, no, we only move in quarters. That's just proof to me that they make this stuff up because no market moves in quarters.
Right. One of the things that I remember reading from, unfortunately, I didn't know Milton Friedman, but one of the things I remember reading and hearing from recordings of Milton Friedman, was talking about the reason why governments like inflation is that it reduces the real value of the debt outstanding.
Right.
Do you think that is a part of is there a sense that maybe Washington is okay with some inflation?
Oh yeah, absolutely. It in the end. By the way, just a quick aside, as you were saying that, it's everybody needs to read and listen to Milton Friedman. Free to Choose, that whole series.
Oh yeah, that's great.
It's like, and his books. I mean, we haven't had inflation in 40 years, and if we don't go back and remind ourselves or learn about it, and you can with books and video recordings of Milton Friedman and others, we're going to be lost. So yes, I knew Milton Friedman. I hope I didn't sound like I was trying to brag. I just am that old. And
you're in Chicago.
And I was in Chicago and a member of the Mont Pelerin Society and all that stuff. But so I got lucky, and I was in economics, and my boss knew him really well, and so I got really lucky. But anyway, so to go back to this, government, they think they like inflation, all right? Because at first, when you print all this money, it's kind of like morphine. It makes you feel really good, all right? And then it wears off, and you got a hangover. It's like caffeine, and you're jamming for your test, and then once you take your test, you pass out because you stayed up all night, And so it's a fake feeling, and then it comes with inflation. And the problem with inflation is voters hate it because it undermines their living standards. And so I go back to the 70s when we had the last real problem of inflation. Jimmy Carter was a one-term president. If you look all over this country, we had one-term mayors, one-term governors. I always call inflation a political kryptonite. It undermines all your decisions. You're planning for retirement, your budget, for your household, cost of your vacations, the cost of building that new house. If you're a business, the cost. During the 70s, cost overruns were everywhere. They'd say, we're going to build this bridge for $800 million, and the next thing you know, it's $1.5 billion.
Right,
and that was real money back then. Now it's trillions and hundreds of billions. So what an inflation may look good on paper because it devalues debt in real terms. In reality, it's devastating.
Okay, so you've been forecasting that there's a recession on the horizon. Nobody knows until it comes, what it's going to be like. But if you had to, I guess, forecast the severity, the depth, what sort of recession do you expect? Is there an analogy that you could point to, maybe a previous recession that it might be like?
Yeah. Well, it's not 2008.
Okay.
All right. We don't have mark-to-market accounting. The banks are not, they're not squeezed on liquidity. They have abundant reserves. So this is not 08. It's also not 1999, 2000, dot-com crash. I think there is some resemblance to that in that I remember people in 98, 99 saying we would never have a recession again. Today, what I hear people saying is AI is going to save the world,
right? Which
basically is the same kind of thing. It's technology. Back then it was technology, the internet, all that stuff. Today it's AI that's going to be the savior. So I see a little similarities. The difference is by the late 99, the market was over 60%. It was 60% overvalued. Today it's 30. Okay. All right. So we're nowhere near that. I think one thing I do believe is that it's going to feel worse than it will be. And here's the reason. People don't pay attention to M2. So we already talked about this. It's like we saw M2 going up in mid 2000. We wrote about inflation first time in July of 2020. Fed said, it's never going to happen. All these other economists said it's never going to happen. And then boom, it did. Then they said it was transitory. Then they found out it wasn't. In other words, it was all a big surprise. And so if you don't pay attention to M2, it was a surprise. And I think the recession is going to be a surprise. I just like the inflation was. And so it's going to, at first, it's going to be like, wait, what's going on? Why is this happening? The bottom's dropping out. Unemployment's going up. But in the end, I think it's going to be more like 90, 91. The Fed will cut rates. We have to cut the size of government. That's a different issue for a different day to really get growth back up. But in 91, unemployment went to 6.5%, if I remember correctly, whereas in 2000 and in 08, 09, it went to 10. So I'm looking for more of a kind of a normal, even though nothing we've done in the last 3.5 years is normal with all this COVID and pandemic stuff. It's more, that's what I'm looking for. 30% drop in the stock market, 6.5% unemployment rate, Fed eases, and as we move out of 24 and into 25, we can actually get some growth back.
So you mentioned the valuation metrics, and that's based, I believe, on your capitalized profits model that your team has published for a long time. Maybe as we kind of wrap things up, if you would kind of give a summary of that, and why is that a good metric, and really more importantly, how do financial professionals look? How do they use that?
Right.
How does it apply?
Yeah, this is a good question. So we use a capitalized profits model. I'm a believer in keeping things simple. Like I don't think economics is that hard. All right. And so what are the two most important things for stock values? Number one is profits. If you don't have profits, I mean, I'm not saying a stock price it can't go up if the company doesn't have profits. I mean, remember 98, 99, we didn't like profits because we're buying market share, right?
Yeah. So you wanted cash burn back then,
right?
For some reason.
Yes, exactly. And then eventually we found out that was stupid.
Yeah,
all right. So and then the market collapsed. So I want profits. Number one. Number two, we use a discount rate, and we use the 10-year Treasury. So the higher the yield is, the less profits are worth. The lower the yield is, the more profits are worth. So we have 70 years worth of data. We know what profits were. We know what the 10-year was. We know what the S&P 500 was. And it's a simple 3-variable model. You give me 2, I can solve for the third. We just do it on averages. So what that model says today, by the way, for 14 years, it said we were undervalued. And I was bullish forever. And people started calling me a perma-bull, which now I hope they know isn't true because I'm not bullish anymore. Because if you put a 4% 10-year, you're worth about 3,300 on the S&P, and it's trading about 4,300. If you put a 4.5, I don't even want to tell you what the number is. All right, and that's where we are today. What I will tell you is that in 2019, I'm going to give total averages here. The S&P 500 averaged 3,000, a little bit less than 3,000. That was pre-COVID. And then we lock down the economy. We borrow all this money. We print all this money. We put ourselves in a worse financial condition, have 6 million fewer jobs on average for 3 years in a row. And yet the stock market was worth almost 5,000, the S&P. So it went from 3,000 almost 5,000. It's now back to about 4,300. But my belief is that we could go down to 3,000. It's not the same as 08, 09, and I think once that's done, it's not going to overreact. We're not going to collapse. We'll have lower earnings, higher interest rates for longer, although I think they're getting close to their peak. And then finally, let me just tell you that this model is not a trading model. I would never run a hedge fund off of it. It's an indicator. And what it says now is with profits as they are, with the 10-year about where it is, we're overvalued. Not like we were in 99, but we're overvalued. So I would argue that favors profits need to go up 40% from here for the market to be fairly valued today. We've already had a 100% rise in profits during COVID. I just think that extra 40, I don't know where it comes from.
Mm-hmm.
And so I would argue the downside is greater than the upside. It doesn't mean get short. Like, that's not what this is. And so where I'll close, even though you didn't ask, but is the high value part of the growth stocks are the things that cost too much, the Magnificent Seven or whatever.
Right.
There are still a lot of sectors. If you look at energy companies versus their contribution to earnings of the S&P, they're way undervalued. And so are low val stocks, so are value stocks. And I remind everybody, look at 2001, 2002, 2003. Because that was the dot-com crash. The S&P 500 fell, I think, on average over 20% a year for 3 years in a row.
Right.
Low vol and value both rose.
Yeah.
So I don't want people to be out of the market or short the market, but it is time to be, I hate the word defensive, but to move into sectors that are cheaper than these high-flying.
So I'm hearing you say we should be more selective. Maybe don't just buy the S&P 500, but focus on those areas where there's value, where there may be growth that's not priced in already.
Yep, that's exactly right. The Magnificent Seven are just too big of a share. I mean, Apple itself, I think, is a bigger share of the market cap in the S&P 500 than all the energy companies combined.
Yeah.
And to me, I'm not saying Apple's not a great company.
Sure.
But I find that kind of incomprehensible.
That's one of the analogies to, the 2000 period that makes, I think it's so comparable. The top heaviness of the S&P 500, it's even more top heavy than it is today than it was then.
Yeah, exactly. And so that's why the model doesn't say get short. Model says the market's overvalued, but that doesn't mean every sector is.
So be selective, maybe adjust your asset allocation because there's some better values and some fixed income than stocks.
Right.
Is that?
Absolutely.
Yeah.
Yeah, fixed income now. It used to be you got zero.
Right.
And now you're getting, 5% return, especially when the market's a little overvalued. Overvalued. I don't need to say little. It's overvalued.
Sure.
5% return or 4.5 now on the 10-year. I don't know if I'd go all the way out to 10 because I think interest rates could still go up from here. But because I don't think inflation is gonna it's over. A lot of people think it's going to be 2% by the end of the year. I am not in that camp. And if the Fed reverses course, then get ready, it's going even higher. But a 2-year, 3-year, in the 70s, the kind of a 2-3 kind of rolling bond portfolio, 2-year, 3-year rolling bond portfolio beat the 10 and it beat the 3-month. So it was sort of catch that point on the curve where it goes up. But it's not the cash and it's not the longer rates. And that's kind of where I would be. That's what won in the 70s. You're actually getting paid the whole fixed income now.
Right,
It's been a long time because the Fed has held those rates so artificially low.
Okay, so on the ROI podcast, we like to end with something optimistic.
Right.
You have been accused for a long time of being too optimistic. Now some people are like, well, a recession, Wesbury's saying a recession, he's too pessimistic.
Right.
I want to hear some optimism from Brian Wesbury. So what are you optimistic about looking forward?
Here's what I'm optimistic about, and that is it's really, and this is where you have to decide, in my heart of hearts, I'm an optimistic guy. Right. And especially about America. And the reason I am is because we have the U.S. Constitution. People love saying, democracies fail after 200 years. And sort of kind of true. It's not exact, but I get what they mean, you know. And there's a lot of people that feel like that about the United States. But what I would argue is there's only one U.S. Constitution. And so the Roman Empire didn't have it, the Greeks didn't have it. Like all those failed democracies, the Peloponnesians, they didn't have the U.S. Constitution. There's only one, and it hasn't failed yet. And I don't think it will. And so I do believe the pendulum will swing back. The pendulum swung in the Civil War, in the 70s, in the Civil Rights Movement. Like the pendulum has swung, FDR in the Great Depression, as far as I'm concerned, was a socialist. And yet the pendulum swung back. And I think we're in the process of seeing that pendulum swing back. And that's what will, the Fed will cut rates and we'll get through this business cycle. But what we really need is the pendulum to swing back, slow down government spending, get the Fed on a much more realistic kind of level of interest rates and money supply growth. And I think we can move to all-time highs.
Man, there's so many other things I could talk about, but size of government being one of them I've heard you talk. Well, maybe we'll save that one for next time.
All right, perfect, Brian.
Thank you for being on the ROI podcast. Really appreciate it. It's always great chatting with you. Thanks to all of you for joining us as well. We look forward to talking to you next time.
All right. Thanks, Ryan.